Hi, everyone. I'm David Silver, CEO of Instrumental Wealth, and joining me today is Matt Harbert, Chief Investment Officer for Instrumental Wealth. And Matt, a lot of data came through in the second quarter of 2023. We're going to break down here for our clients and viewers here this afternoon. We obviously saw the ramifications of what took place from the regional banking crisis that we experienced in early March. The Fed's interest rate hikes and what that's done to hopefully combat inflation. Lots to get into here today. Let me go ahead and turn it over to you for a deeper discussion.
Sure. Well, it's certainly been a challenging year for investors so far, as they've had three big fears, such as contagion in the banking crisis, U.S. potentially defaulting on its debt, and the fear of moving into a recession. Fortunately, as of yet, none of those have materialized, and the markets have responded positively. You can see that when you look at the U.S. large, mid, and small cap markets. Each one of those has had some sort of recovery since March. Where does that leave us now? It's all about the usual suspects that we have been talking about over the last year. Inflation, the Fed, and the potential to move into a recession. So let's first look at inflation. So inflation is still elevated versus the Fed's 2% target, but we can see, at least on the headline, that it has drastically come down since its peak last year in June. The peak last year was at 9%. It currently came in at 3%. So we've definitely hit the peak there. We've had a big decline in the headline, taking us all the way down to a third of what it was. On the core number, while it is still a little bit stickier than the headline number, we are starting to see it turn downward. In fact, if you look at the chart on the bottom, this is the month-over-month rate for the core CPI. And its latest reading came in at 0.16%, which was actually the lowest growth rate for the core in nearly 2 years. If we look at the individual components of inflation, we can really see what is driving some of these prices. In the headline number, it really is energy that has really driven that big decline since last year. If you look at gasoline, it's down 26.5% over that time. And energy as a whole is down just under 17%. Now, that being said, food still remains a little bit sticky, so we still have some rates there. So we have some work to do there to bring those numbers down. But it's certainly looking much more positive at this point. When we dig into the core numbers, that is where we are seeing more elevated prices, particularly in the services area. So when you look at shelter is still sitting about 7.8%, and transportation at 8.2% year over year. But there are some positive numbers there. If you look at the month over month rates, they have been decelerating as well. So the question is, what do we think inflation is going to be by the end of the year? Our previous estimate was around 3.5%, but as you can see, it's already past that and down at 3%. But we do think it could potentially, that decline could flatten out a little bit from here, as some of that is from the base effects. June last year was the highest rate of inflation, so that is factored into it positively. As we move forward from there, there's going to be less benefit from the base effects, and some months might even reverse that a little bit. But aside from that, there do remain other areas that will have downward pressure, particularly in the services area, like housing. There's been a big slump in housing, and that hasn't been completely factored into the CPI numbers yet. It is a lag number. So as those start to work its way through, we do expect that to help lower those numbers. And finally, if we do end up in some sort of recession, that will also put downward pressure on prices. Next, if we look at the Fed has been on a drastic tightening cycle over the last year. They've increased rates 500 basis points over that time. And their mindset has essentially been they're scared that inflation will get out of control. However, just recently with the shakeup in the banking sector, as well as such a big decline in inflation, they ended up taking a pause over the last meeting. So they did not hike rates last time. That being said, they made it clear that they were taking a temporary pause, and in their comments, they noted they still expect to raise rates a couple of times this year. So where do we think their course of action is going to be? When you look at the Fed dot plot, it implies that they're going to raise rates two more times, 25 basis points each by the end of the year. They've been signaling a 25 basis point hike in the next meeting, and we do think they're going to follow through on that. However, we're going to be paying close attention to the comments to see if the surprise drop in inflation might impact their decision. Either way, we do think that they're in the tail end of their tightening cycle, so they may do one or two more hikes of 25 basis points, and at that time, we think that they'll probably stop at that with the hikes. Lastly, has what they've been doing worked? You know, our measure of whether they were successful in doing what they're trying to do is kind of twofold. First is, were they able to get inflation down to reasonable levels? But second, were they able to do that while orchestrating a soft landing or at minimum a mild recession? It's probably a little early right now to determine whether they were successful at it, but that would be what we would be looking for to make that decision. What does that mean as far as a recession? Are we out of the woods as far as a recession goes? And we certainly don't think that we're out of the woods yet. However, we do think that if there is a recession, it might end up coming a little later than we initially thought. So we initially were expecting a recession sometime by the end of this year, and that might end up pushing out a little bit later, maybe into 2024. And we think there are a couple of reasons for this. And one is last year, we did end up with 2 negative quarters of GDP. So if you look, first quarter and second quarter, both of those were negative GDP. It was not declared an official recession, but it was pretty obvious that several areas of the economy were in a recession and feeling those recessionary effects. So part of the reason pushing that out is we've already experienced some of those effects in the economy, and there might be some recovery in those areas as we go forward. But second and more important is the ongoing strength in consumption and employment. It continues to surprise on the upside. If we look at the components of GDP, you can see consumption makes up nearly 70% of consumption. That's a huge driver in the economy. And while consumers have faced a lot of headwinds, such as fiscal stimulus has been reduced, prices have been high, and interest rates have been rising, they've remained resilient. And the question is, how have they been able to do that? Backing up a second, if we look at retail and food service sales, we can see that has remained positive. While it's a little under the average, it is positive. And same story in personal spending. It is positive, a little bit lower than the average, but it remains positive, which tells us they continue to spend.
That's right.
And how they've been able to do that, there's really two sources that we feel that have allowed them to continue to spend in the face of all these headwinds. And the first is savings. If we look at the blue mountain chart, we can see the excess savings. Post-COVID, you can see how much consumers were able to build up in their savings, getting to a peak of 2.1 trillion of excess savings. But once the end of 2021 hit, 2022, you can see that started drastically declining, where we're currently went from 2.1 trillion to 4 billion. or sorry, 400 billion.
And that makes a ton of sense, right? I mean, I think about just the obvious here, right? I mean, we had for most of the world, we had about a year to a year and a half where there wasn't much travel going on. There wasn't much in the form of entertainment, concerts, things of that nature. And as that took place, a lot of people took all of that consumer discretionary spending and just put it away. You also had things that allowed for them to save more, like a moratorium on rent, student loan payments being postponed. All of those contributors allowed for a ton of excess. And then as the world reopened and as some of those programs went away, I think it's maybe in August or September, student loan payments are going to continue again. A lot of that excess has continued to evaporate.
That's right. Essentially, consumers were sidelined when COVID hit and we were quarantined, built up a lot of savings in the period of high inflation and higher rates. They've really chipped away at it. And you can also see it in the savings rate in the chart above. So again, post-COVID, the savings rate really increased. But since then, it is plummeted and it is now currently sitting about half of what the average is. While there is still some savings out there for consumers to dip in, there's 400 billion still out there. We think they're going to go through that fairly quickly, and with the significantly reduced savings rate, we don't think that would prolong that out much as well. The other area consumers have tapped into is debt. So if you look at the credit card debt, if you look over here, this is COVID. So post-COVID, they were able to pay off a lot of their debt. But since 2021, they've reaccessed their debt, and you can see they have really skyrocketed, and even reaching a level that's higher than the post-financial crisis. So, or sorry, pre-financial crisis. We do think that this coming at a time with higher interest rates, that's going to make it much more difficult for consumers to service that debt. So we would expect, as this continues, to see delinquency times lengthen and default rates rise. Next, we look at employment, and employment has also continued to be very strong. As you can see, the number of payrolls on the top part of the chart remains very high, and unemployment continues to stay around a 40-year low. So what we're looking at is the labor market to see if there's any softening in this area that would maybe cause this to weaken a little bit. And so when we look at those numbers, we are seeing some softening. So if you look at the first three in the top chart, you can see each of those are sort of trending towards its average. But that being said, the numbers still remain very strong. So job openings are close to double their average, and both hires and quits are well above their average. What this tells us is there are plenty of jobs available for workers. In fact, if you look at the chart below, this is the ratio of openings to workers that are unemployed. You can see how elevated that is, and the number is actually about 1.6 jobs for every single unemployed worker. So there are plenty of jobs out there to be had. When we look at hires, that number is still high, kind of implying that businesses are still having a difficult time finding qualified workers. And quits remain elevated. So workers obviously feel comfortable to leave their current jobs as they think there are still plenty of opportunities available for them. So I think with consumption remaining strong and employment also really robust at this time and the labor market tight, it's hard to see that we would be entering a recession in the near future. So those are some of the reasons we kind of feel that it would be pushed out a little bit. That being said, if we look at some of the sort of traditional predictors of inflation, they're still flashing red. So when we look at the LEI, the leading economic indicators, it is still signaling a recession over the next 12 months. And if we look at the bottom chart, we can see all of the components other than two are either negative or flat. And in many cases, they're significantly negative. So this is still sort of flashing red that we may end up in a recession over the next 12 months. The other indicator is the yield curve. The yield curve is inverted and has been inverted for several months. And typically when this inverts, that indicates a recession coming in about 12 to 18 months. And it has, as I mentioned, already been inverted for several months already. So both of these are still kind of indicating that not everything is okay in the economy, that there is still areas that we have to be concerned about. We do think that there is likely to get into a recession. But overall, we're in a better place than we were last quarter, for sure. The banking crisis is seemingly behind us. The US debt situation has been resolved. Inflation has come significantly down to what it was a year ago. The Fed is at the tail end of their tightening cycle, and markets have improved since March. While we don't think that we will avoid a recession, we do think that the probability that the Fed is able to navigate us into a soft landing has increased. We also think that given the strength of employment and the fact that there is still some savings out there for consumers to tap into, that we will see strength remain in consumption. And so that will push out a potential recession probably till sometime next year. But even then, it's likely to be a mild recession.
Yeah. Matt, I think the thing that comes to mind right away is resiliency, right? I mean, you think about the backdrop of all of the things heading into the second quarter that the U.S. economy was faced with. You mentioned too just a moment ago with the regional banking crisis and the debt ceiling, and was the U.S. going to default or not? And in spite of all of that, resiliency.
Right.
And I think to your point, the probability of a soft landing has certainly increased. Thank you, Matt. As always, I know that our clients love to hear from you, and there's always great nuggets and data points that you are able to provide our clients. And so thank you for sharing that wisdom and knowledge with everybody. And thank you to our clients who continue to send in great questions for Matt to respond to. We always love getting those. And so if you have questions around any material that was covered today, I want to get into a deeper conversation with your advisor, send us a message through social media, hop on our website at instrumentalwealth.com, schedule some time with your advisor. We'd love to have a deeper conversation around any of the material covered here if you have further questions on this. So thanks again for your time and attention, and to be continued in the about 90 days from now. Thanks, everyone. Have a great day.